Okay, welcome back. Let's now apply what we have learned so far in the Princeton Initiative and apply it to an international setting. A paper I wrote with Ulis on international monetary theory, a risk perspective. So the questions we would like to address here is, as I mentioned, is that when can a country, think of a small open economy in the emerging economies, have its own currency or its own safe assets? So when can its own government bond also serve as a store of value to ensure peoples or citizens in this country against idiosyncratic risk? Okay, that's a safe store of value. And you can, of course, always hold the US Treasury as well. And there's a competition between the US Treasury and the country's government bond, for example. And of course, there's additional fragility. So it could be the country loses its own currency. It becomes suddenly dollarized in the extreme case, or nobody wants to hold its own the government bond anymore of this emerging market economy. And that's often, when this suddenly happens, is often referred to as a sudden stop. The exchange rate moves radically. And we would like to understand how this framework helps us to understand that. So instead of focusing on price stickiness and other elements, we focus really on the finance component, I think, because we think it's really risk premia, shifts in equilibria. That's really what's important in order to understand financial crisis in the context of emerging economies. The other question which often comes up, to what extent is US monetary policy spilling over to emerging market economies? So if you think about India, other kind of emerging economies, there's always a complaint that the US Fed's policy has huge implications for the economies in these other countries. So we would like to understand that. And is actually then the emerging market developing economies, are there independent monetary policies? Do they have the sovereignty or not? Or they're mostly driven what the US is doing because they have open borders and everything is just flowing in and flowing out, capital flows and coming in and out. And there's this saying also promoted by Ellen Ray, we don't have a trilemma. The classic trilemma says, okay, you have 3 desired features and you can only have 2 out of them. So you would like to have free capital flow, no capital controls. You would like to have a fixed low volatility exchange rate, and we would like to have some independent monetary policy, but you can only have 2 out of these 3. And what the argument is, actually it's a dilemma, because even if you have capital controls on and other things, it's still the case that you cannot fully control your own monetary policy. And we will understand this, and this framework will give you the explanation why that's the case. More generally, there's an integrated policy framework with it. How does monetary policy, capital controls, macroprudential policy, and fiscal policy, how does it interact? Just to give you some background, in March 2000, with the COVID crisis, there was a huge outflow of capital flows. There was huge. It was unprecedented. So what I depict here essentially is that you see the data comes originally from the IFF, and that's drawn here by the Fed board chart, where you see a decline of the most recent in March. You see a huge outflow of capital from the emerging economies compared to previous crises. So compared to the global financial crisis, that's this light blue line, compared to a taper tantrum, that's the pink line, compared to the China scare, which happened earlier. So all of them are dramatic. So this is in billions of dollars, and this is in percentage of GDPs. In both dimensions, it's a huge shifts going on. The other thing I would like to emphasize is in March 2020, there was a huge scare. Everything went down wire, and then the Fed stepped in and stabilized, cut the interest rate, allowed many measures, and that's actually helped to stabilize the situation. You see a huge stabilization subsequently. So this is from the start of the crisis, when the COVID was the outbreak, you see this huge, these are the days after the start of the crisis on the x-axis. So you see these huge outflows in March 2020, and then in April 2020, because of the Fed interventions of this huge stabilization, and you see also even further, so I haven't drawn it further, that actually came back to some extent. So we would like to understand the sudden stop here. So what is the outline? So we would like to understand the safe asset and frictions in a world with friction, safe asset and money in frictions, where people smooth consumptions across states, so they try to insure themselves against idiosyncratic shocks. And but there's a friction incubate markets like Bewley and the paper we talked about yesterday. And there's also countrywide shocks. Okay, and it's costly to insure against these countrywide shocks. So it's not incomplete, but it's costly, and we will see in what way.
Sorry.
And then you would like to smooth across time as well. And the way you smooth across time, you can hold some safe asset, some US dollar, we can hold the local government bond as well. So the two currencies, two safe assets, the international dollar, we take the dollar as the international currency, and the peso, where I use this peso sign as for the peso. So strictly speaking, historically, the dollar sign was a peso sign as well, but I use the peso sign here. What are the main results? The peso value in the interest rate is endogenous in this framework, and it's in idiosyncratic risk. The amount of idiosyncratic risk in this economy is inverted U-shaped. Okay, so there will be, if very low idiosyncratic risk, the peso is not worth much. If it's very high idiosyncratic risk, the peso is not worth much. The peso can only live as a separate currency or as a separate safe asset bond if the idiosyncratic risk is in intermediate range. Okay, there's competition between the two currencies, and typically, ideally, would like the dollar to ensure the countrywide risk, and the peso to ensure the idiosyncratic risk among the citizens in the country. Okay, that's ideally what the planner would like to do. The problem is the dollar also allows citizens to ensure idiosyncratic risk and might take over, and that makes actually things inefficient. There will be sudden stop if the idiosyncratic risk becomes too high. Suddenly, everybody rushes into the dollar. So in normal circumstances, we borrow in dollars because the dollar interest rate is lower in the emerging economy. And then suddenly it switches, you save in dollars. You use dollars as a safe asset. There's this huge capital outflow coming on, as I've shown initially. And with this comes a huge peso devaluation along. And we will show that how the monetary policy spills over to the other side. So more generally, and that goes a little bit more general, what is a safe asset? So I have to explain first what a safe asset is. So typically when we do asset pricing, we always say there's an expected present discounted value of cash flows like dividends and interest payments and so forth. But assets also have a certain cash flow, a service flow. So they not only have service flows, cash flows, but also service flows. What do I mean by that? And if you generalize the asset pricing framework, you can have an asset which relaxes collateral constraints. So there's a Lagrange constraint, there's a Lagrange multiplier on this constraint, and it relaxes this constraint. So an asset might have a higher price because it has a service flow of relaxing collateral constraints. Okay, so what I've depicted here is a big bubble. The blue one is all assets together. And then I have a smaller one, which are the collateral assets. These are good collateral assets. And then we have this light green bubble here. That's the safe asset. And what's a safe asset? It's exactly what we did yesterday. A safe asset is when you suffer an idiosyncratic shock, your washing machine breaks down, you have some saving, you can sell it easily and buy a new washing machine, okay, or buy a new car, whatever breaks down. And what's really key for that is it is around, it doesn't lose value when you suffer this idiosyncratic shock, and you can easily trade it. So there's a high market liquidity. There's no huge bid-ask spread on it. And in our setting, there was no bid-ask spread on it as well. So it's a good friend. So I call it a safe asset has two characteristics. One is the good friend analogy. Whenever you're in difficulties, it is around, okay, like a good friend. You can sell it. Then, of course, there's another sense, which is if you view more narrow money, the narrow money is on top of a safe asset, also has a feature that it relaxes the double coincidence of wants constraint. So if you have, if you go on a shop and you want to pay, you can't use the US Treasury to pay with it. You have to pay with dollar bills, okay? And in this sense, this double coincidence of wants constraint, money is even more liquid. That's within this green bubble. It even has a higher price. Whenever you have a higher price, it means the cash payoff is lower because it gives you a higher service flow. And I would like to classify assets this way. And I focus here today, I focus very much on the safe assets considerations, okay? The other problem, which makes the whole thing interesting, is that the safe asset is driven by a safe asset tautology. That's the second feature I would like to emphasize. So the second feature says an asset is safe because it's considered to be safe. Okay, that's a little bit of tautology. And What is that? So if there's a crisis, we rush into a particular safe asset, it will gain in value because others rush in it too. So we have to coordinate something. If you all agree on a green piece of paper to rush into, then this green piece of paper will be worthwhile because we know in times of crisis it will appreciate in value. Okay, so that's a little bit what the safe asset tautology means, and it is exactly this bubble value we talked about yesterday in the I theory of money, where you have this bubble component. So you can have a bubble on that piece of paper or that piece of paper that's not clear which piece of paper it is on. So and this bubble component might burst away. So that makes it also fragile. Okay. Now let me go into the results for the optimal policy and all this. But in the interest of time, I jump over this for a minute. So there's a lot of related literature. We talked already about the OLG models, like Samuelson's OLG model without capitals and diamonds. And then you have all this idiosyncratic endowment risk. We talked about this as well with Bewley, Ayagari, then idiosyncratic capital risk, where actually, depending on your portfolio choice, if you put more into this physical capital, you get also more idiosyncratic risk. And Yuli and I, we have worked a lot in that framework. And this paper essentially focuses very much on this risk perspective of the international monetary theory. And we have a policy piece which, you know, has this integrated policy framework. If you have a low-tech way of reading it, and a lot of ideas are there in this policy piece we wrote more recently. Okay, so then there's a lot of other literature which is summarized here. Let me just jump into the model. Okay, so it's a small open economy. It's an AK model, so individuals produce output goods from capital. And there are two currencies. There is a local currency, the peso, or with public debt, so the peso debt. And individuals can save against, to have some precautionary savings against idiosyncratic risk for that. And then there's the dollar, think of the US Treasury, and individuals can save and borrow to save against aggregate countrywide shocks, okay? But they can also use the dollar to save against idiosyncratic risk. There's nothing preventing that. There's currency competition between the peso and the dollar. And so typically, you know, the planner would actually, we will see later on, that you use for idiosyncratic risk the peso, while for the countrywide shocks, you use the dollar as a precautionary savings tool. And we will derive how this currency competition is playing out. So more specifically, we have the same setting as usual. So we have time reference rate of rho. We have the risk aversion coefficient of gamma, and the IES, intertable elasticity of substitution, is 1 over gamma. You can have, as was mentioned previously, you can have some epsilon sin if you want. Now the evolution of net worth is what we did always. So we had, you know, you have some return, so portfolio share into dollars, you have portfolio share into the peso, and they get the return on money or on the peso money. So this M should be a peso sign. You get the return on dollar. The return on dollar we take exhaustively as given. It's a small open economy. And then the remaining part you put into your physical capital. You know, it has a little bit of an I tilde on it because there's idiosyncratic risk attached to that. Okay, like as usual. And then the consumption goes away, it reduces your net worth. So that's your budget constraint. Again, these are the portfolio shares, and the portfolio share in the peso, I dropped the superscript, the little peso superscript, okay, because that's what our object of interest is. Okay, so now what's going on in this framework? It's slightly different. So the shock structure is slightly different because instead of shocking capital, now we shock actually output. Okay, it's still a Brownian shocks, but we shock output here. So we have the following here. So that's the consumption output is A minus iota. So that's what we always had. So here I took away iota right away for reinvestment. And then there's a countrywide shock. So DC is a countrywide shock. And then there are idiosyncratic shocks. So that's for the guy I, okay, for an individual citizen in this country. Sigma is the country, the loading on the countrywide Brownian. Sigma tilde, everything with tilde is idiosyncratic shock on the country. And that's geometric, so everything is multiplied by k. So everything is k scalable, your own k, the little k there. And it's a shock it's not a shock on the capital stock as we had before, it's a shock on the output. It's what we often refer to as cash flow shock. Okay, so you shock your output directly. And how does your capital stock evolve? So the capital stock itself is not shocked. So it's just the investment rate, iota, times you have this adjustment cost function phi, as we always had, minus delta. And this is a geometric, so we have to multiply by k. I could have divided it through and divide over there. And then you can also buy some additional machines. Now, the purchase of additional machines, I call this d delta. Okay, that's the additional purchase of this individual guy, I tilde. Okay, so you can buy some machines. If you buy some machines, he has to pay for it. So previously we only had the evolution of capital, and then you have, of course, the evolution of the remaining pesos. But here we have capital, pesos, and dollars. So we can drop one by the budget constraint, but we still have also the evolution of the dollar position. And you note this, by the dollar sign smaller, this the individual dollar holding of this I tilde guy. So he gets some interest payment from the dollar holding. He consumes out of it, and he sells something. And he sells it our numeraire as the consumption unit, and it can also be the dollar unit. Okay, so dollar is our numeraire. There's flexible prices, so there's no price stickiness to worry about. And if he buys a machine, then he has to pay for it, and the price of the machine is Q. Okay, there should be a K, capital K on it. I dropped that, I forgot about that. So that's what's going on. So now there comes an additional assumption, and that's relatively new. So what's different from previously what we had? One difference is that we have this cash flow type shocks, not on capital, but directly on output. The other difference is you can buy a machine within a country at the country price, or you can buy it from the world market. Okay, so think of a country like Chile. It can buy the physical capital within the country. You buy it at Q and a QK. But if the country as a whole wants to buy more machines than it wants to sell, so if this is the case, then actually you go to the world market, and the world market is such that if you want to buy from the world market, you have to buy at a Q upper bar. If you want to sell to the world market, there's a Q lower bar. Okay, it's like an SS band. So in the world market, the price is fixed to your small open economy, so you don't impact the world price. But there's a Q upper bar and there's a Q lower bar. So there's a bid-ask spread in a sense. Of course, if all of Chile doesn't want to buy from the world market, then it's not a big deal, because we are in this the Q is in this range, but it never goes beyond. The Q is never going beyond that, because if Q were to go beyond Q upper bar, people would just buy from abroad. Okay, and Q would never drop below Q lower bar, because if this were the case, Chileans would just sell it to other countries, okay, rather than selling to their fellow countrymen. Okay.
Markus?
Yes?
I have two questions here. So the first is, why did you choose to model it as a cash flow shock and not a shock to the capital, which is on the stock? And second, can a small open economy only buy from the world when it cannot cater it? Or does it have the choice to go to the world economy even when it can cater the capital demand?
So we did the cash flow shock because there's some nicer features on certain aspects in the welfare analysis. We will come to this later on. You could have used the other shock structure as well. So it would have a little bit, the welfare analysis would have turned out a little bit differently. I will come to this later on. It's not obvious yet what the differences are. It will be more obvious once I show you some equations. And the second, they're both are good questions. The second question, so remind me again, the second question was about the Qs. Why do you interact with the world market not all the time, or?
Yeah, in other words, will the world market only, so will the open economy only go to the world market if it cannot cater the demand internally, or it has a choice to go wherever it wants?
So what's happening is that going to the world market is costly. You can think of some trading costs. It might be let me make a particular number. So Q lower bar is 90 and Q upper bar is 110, let's say. It could be that the machines or the physical capital in the country trades at 105. And that's an equilibrium. Demand is equal to supply inside the country. So nobody wants to trade on the world market, buy at 110 or sell at 90. Okay. Only if there are some imbalances large enough within Chile that they want to buy a lot, and the domestic market, if it were closed, the price would go up to 111. They would actually then go to the world market and say, well, now I buy to the world market for 110. Okay, so this actually squeezes so the capital price inside this band. Does this answer your question?
Great. Oh. Yeah. Thank you.
And then there are three frictions we consider. So one friction is that there's uninsurable countrywide risk with foreigners. So the foreigners cannot really you cannot trade derivatives with foreigners such that you can insure this countrywide risk DC. Okay, that's the first friction. We can relax it. You cannot fully insure and only partially insure. You can generalize that. It makes it quantitatively different, but not qualitatively. The other thing is the uninsurable idiosyncratic risk. The idiosyncratic risk is like in the previous models, you know, your own restaurant doing well or not doing well, you cannot insure in financial markets. And now what's also new is, that's a new element as well, is that how much can you borrow from abroad is subject to a collateral constraint. Okay, so how much you can borrow is actually you buy a machine or some number of machines K, or how many machines you have, you can collateralize it, but you can only collateralize because when you borrow from abroad in dollars, you can only essentially borrow up to Q lower bar. Why Q lower bar? If you have to sell the machines abroad, that's what you get, Q lower bar per machine. Okay. And that's how, so the dollar, this is a dollar holding being long, so they can go negative, so they can't go more negative than this amount. That's a collateral constraint. Okay. Now let's look at this model. So now let's look at the aggregate variables on the assets. So it will be as usual the case that the IOTA is the same inside the country. They are all scaled up versions of each other. They experience, of course, idiosyncratic risks. And you know, if you have 10 positive shocks and I have 10 negative shocks, you will be wealthier than me, but you're just, you know, a scaled up version of me, because everything is bigger, you're wealthier, you invest more, everything proportionally higher. So the aggregation within the country is working well. So, but we have a state variable. One state variable is this K, which is, you know, runs pretty exogenously outside, because this IOTA, we only have to determine this IOTA, and then it runs exogenously outside. So that's our K we had always. And you can sell some of your capital, then the capital stock is going down. That's your cells, this delta lower bar. And you can buy some, then the capital stock is going up. Now that's a plus sign here, so increase. But of course, this has effect. If you buy abroad, it affects your dollar positions. That's now a capital dollar sign. So it's for all of the dollars. And you can see that that's typically a dollar position. As we had earlier, you get the dollar interest rate, you consume as a country, and then depends how many machines you sell abroad, that's you get Q lower bar from these machines, and how many you buy, there's a minus sign. And then of course you also have the output, okay? Because of output you get also something, you can increase your dollar position. Okay, now as we did with, you remember we had this QB in the I theory without I paper. Now we want to do everything scale invariant with respect to K, because that's our one state where we want to keep everything scale invariant with. So instead of using the dollars as state variable, the dollar holdings of the country, well, let's think of the US Treasury bond holdings of Chile, we look at as scaled as divided by K, and we call this nu, okay? So we have the state variable is our main state variable will be nu. Okay, so rather than having two sectors with relative wealth, now it's a state variable is nu, which is the dollar holding per capital stock, capital unit. Okay. And we can, of course, now we can divide this process with this process, what we use Ito's ratio rule. That's what you just used for this eta process. You can do the same thing here. So you get the drift of this guy here, showing up here, minus the drift of this guy, so that's showing up here. And you can get you get this expression here, okay? That's just taking two stochastic processes, take the ratio of two stochastic processes, and then you get a new stochastic process and using Ito's ratio rule. Okay.
Markus?
Yes.
How about consumption there? Are you assuming it's a proportion of the wealth?
Consumption will be, yes, so I will derive the first order conditions, and the optimality you will see it will be proportional of wealth. Okay, you will see in a minute. I want to specify, before I do that, specify the returns. So we have the state variables and then the asset returns. That's what we do in step number 0. Then we say, okay, let's, what's the return on the peso money, on the peso, essentially. So that's essentially what he has. What is the return on the peso money? It's the growth rate of the economy. Remember again, what we had earlier, we had this growth rate on the economy, and the growth rate on the economy, if there's money supply growth rate or bond supply growth rate is 0 and the economy grows at 3%, then there will be a deflation of 3%. That's the return you get from this. Minus this mu peso check. We had this earlier too, this mu peso check. That's how much interest you pay in the pesos relative what you print money. So if you don't pay any interest on the pesos, you don't pay any interest, you just print money at the rate of 4%, then the real return on money is minus 1%, because the economy grows at 3%, you print new bonds at 4%, then you get a return of minus 1% in real terms. Then it's the same thing we have to do for the physical capital. What's the return on this? So there's a countrywide shock and there's an idiosyncratic shock. Because we had this output shocks, now it's sigma divided by Q, okay? And sigma tilde divided by Q. So this is QK, these are both are QKs. Now the return on capital is, again, we have a dividend yield, we have the aggregate shock, the countrywide shock, then we have the idiosyncratic shock, and that's now dividend yield. All of this is a dividend yield because we have this cash flow shocks. Now this affects the output, as I mentioned earlier, this risk as well. Then there's the capital gains, and the capital gains themselves are deterministic because we have no capital shock now. So it's actually a dividend shock, which is stochastic. And then we get the seigniorage. What's the seigniorage? If you print additional, go into debt, there will be seigniorage, there will be additional bonds issued, you get some resources, whom do you give it to? You can give it to the capital owners, or you can give it to the money holders, and we had these 3 ways you can distribute that last time. And as long as you don't give it fully to the money holders, there will be actually a distribution towards the capital holders, as we mentioned last time. Now, what's going on? So in this model, if you are an individual citizen, if you have idiosyncratic shocks, you essentially have a negative shock, you sell some of this capital in order to make up for this negative shock and to readjust the portfolio to the previous portfolio weight or whatever the optimal portfolio weight is after this negative shock. If you have a positive shock, you buy more capital to grow your firm, okay? So here it's different, a cash flow shock is different because the capital is not destroyed and you have to not replace the old capital with new capital. It's just a cash flow shock. It means you have less, cash because of the cash flow is going down. And that means, you have less cash now. You want to sell some of your machines in order to get to the old optimal portfolio ratio again. If it's a countrywide shock, as I mentioned earlier, you have to go to the international markets. And then there's this SS bound where, international markets, if the whole country wants to buy a lot of machines, they have to pay this Q upper bar. And if the whole country wants to sell, you buy at this Q lower bar. So the Q itself is bounded within this Q upper bar and Q lower bar because it can move inside, it moves, you know, if there's selling pressure in the whole country, you push down the Q, and at some point it's bounded, because then the international capital markets comes in and buys and sells machines from you. Okay, so what I want to do is to look at a setting, go step by step, just to explain what's going on in this paper. So the first thing, let's just switch off all country-wide shocks. Let's only have idiosyncratic risk. And I would like to look first at a case where there's total autarky. So the capital controls are on. Nobody can hold dollars, okay? And then you can only hold pesos, only a local currency. And then what I will do is then I add later on, I add the dollar, okay? Then there's room, and we show in this setting, there's only room for one currency essentially, or that both currencies have to be perfect substitutes. And then I see, okay, what's the policy space in there, and what is the optimal policy versus what's the equilibrium outcome. And then I move to the next setting, where I said I switch off the idiosyncratic shocks and only switch on the country-wide shocks. And then we show the equilibrium outcome is equal to the optimal policy outcome. Okay, the social planner will pick the equilibrium. And then finally, I will put both things together, where you look at the idiosyncratic shocks and the country-wide shocks simultaneously, what's going on. But the big insights come to a large extent already from this. You can then get some insights as well. Okay, so let's solve for the steady state, and let's, as I said, let's get rid of the country-wide shocks for now. So I crossed this out. I don't know whether you can see this. It's a blue line. It's probably more difficult to see than I anticipated. And so we propose a constant price process, so the peso price process and the, so this should be Q peso and Q capital. Okay, they're both constants, so they don't move around. But of course, there's still a stochastic discount factor process, which doesn't load on the aggregate shocks because we don't have aggregate shocks, but it loads on idiosyncratic shocks. So there's a price of idiosyncratic risk. This was sigma tilde we always had in our notation. Of course, there's, you know, this the risk-free rate, if in a steady state, is not moving around, it will be a constant as well. The return on money, on the peso money, is given by this expression. As I mentioned earlier, we had this equation just a minute ago, and that's the growth rate of the economy as well. And that's important. Let's keep this in mind. That's growth rate of economy, and then there's this money printing going on. And that's the same we had before. The return on capital. The only difference is here I switched off this aggregate shock. So otherwise it's the same equation we had before. And again, this last term is from redistributing the seniorage outcome. Okay, so then we have to look at the optimal choices. And let me just do it for gamma equals 1 for the log case. Okay, so that makes it simpler. And then, so first we do the optimal choices, the optimal investment rate, optimal consumption, and optimal portfolio. And then we do market clearing. Now, what's the optimal investment rate? The optimal investment rate we have done so many times before. You did in your problem set. That's what you do. To maximize simply, it's a static problem, maximize the return. Where does iota show up? It shows up here. It shows up here. And then you get the Tobin's Q relationship, plug in this particular functional form we like, the log specification with the adjustment cost little phi, you get essentially then this outcome here for the investment rate. Optimal consumption with log utility is just consumption net worth ratio is equals to rho, the time preference rate. Then the aggregate consumption is just rho times the net worth in the whole economy. What's the net worth in the whole economy? And there's I have only the pesos now. I'm in autarky. There's no dollar wealth. So I have only the pesos wealth, Q peso times per K. So this was the notation we had yesterday too. So Q of peso times capital K is the total peso holding, total peso wealth in the economy. And then there's of course the whole wealth which comes from the machines. Then we have this portfolio holding, so that's also the same we had yesterday, is slightly modified. The expected return on capital is the risk-free rate plus a risk premium, which is the price of risk plus the idiosyncratic risk on this return. And the price of risk is var sigma tilde plus times sigma tilde. And there's no aggregate risk because we have switched off the countrywide risk. Okay. What is the price of risk? Or the risk of the return is just sigma tilde divided by qk. That's we have seen earlier why that's the case. And then if you fill everything out, fill everything in, what's the expected return. So then you get the price of risk is essentially the volatility in log specification. It's just the volatility of the net worth. So how much risk do you take on? That's a sigma tilde times 1 minus theta. Remember, there's no dollar. So it's just 1 minus theta is how much you hold in physical capital, and theta how much you hold in pesos. So that's what you have. And then divided by qk, because risk specification was in cash flow risk rather than in capital shock. So you have to divide it by qk. That's what the difference is, what Vendra asked earlier. Plug everything in, solve for this, and hence we have this expression for the theta, the portfolio share. That was the optimality conditions. Now we impose market clearing. So there's a goods market clearing condition. So total demand for apples has to be total supply of apples. That's what we have here. There's only idiosyncratic risk that washes out in the aggregate. There's no countrywide risk, so it doesn't show up here. And then we have portfolio, the total capital markets has to be each person's share in the capital, that's this 1 minus theta, has to be equals to the aggregate share of the physical capital relative to total wealth. That's 1 minus var theta. Okay, and that's that these two have to be the same. So theta has to be equals to var theta. So that's our var theta here, showing up here. And that what is this? It's just qk times k. So that's the value of all the machines divided by the value of all the machines plus the value of all the pesos. Okay, and that's what this thing is. Now you put everything together and you can solve it in closed form. And that we got so excited yesterday about being able to solve this in closed form. And you can do it with this cash flow risk the same way. Okay, it's a different formula. This formula is slightly different because we have a different shock structure, but you can still solve it in closed form. And as I mentioned, you know, there are many Aggregate type models. You cannot never solve it in closed form to such a degree with this idiosyncratic risk. And that makes this a very good workhorse model to start out with, to understand money and then put more bells and whistles on it. But the baseline model you can solve in closed form. And we also showed yesterday, if I change the idiosyncratic risk here on the x-axis, so if I move along the x-axis here, it is the case that you have more or less idiosyncratic risk. And if the idiosyncratic risk is, if there's a change in steady state from a idiosyncratic risk of this level to this higher level, the value of the currency is going up, the peso or the Q peso is going up, and the value of the machine, of a single machine, or the price of a machine is going down. Okay, so this you can see on these two settings. What I've done here for this figure, I put the growth rate of the money supply, I put it equal to 0. So there are no peso printings. Okay. Okay. So now let me introduce the dollar on adding the dollar to it. Okay. So that's the next step. So far I didn't have any dollar, just add the dollar to it. So the question is, if I have only idiosyncratic risk, when can it be, is it the case that the peso can survive next to the dollar? Okay. So without you know, there's also always an equilibrium where there's no peso. When there's no peso, then the citizens would decide between capital stock and the dollar. And they can also borrow in the dollar, they can go short the dollar, but they can only, because of the collateral constraint, they can only go short to a certain degree. Okay. So, but typically, the higher the idiosyncratic risk is, the higher the dollar holding is. And that's what you see in this figure here. So let's look at this figure more clearly. So that's what's here on the x-axis is the amount of idiosyncratic risk. So here the idiosyncratic risk is low, here the idiosyncratic risk is high. Okay. Here is the 0 point. If you go below that, it means you borrow in dollars. If you go above that, you means you hoard dollars. Okay. And what you see is that if the idiosyncratic risk is fairly low, you want to borrow in dollars because the dollar, in this specification, the dollar interest rate is fairly low. The dollar interest rate is, in real terms, we said only 2%. In the real world, it's even lower than that. Okay, so you want to borrow in dollars and invest in your own shop, because your shop, you're way more productive investing in your shop. So in emerging economies, the growth rate is typically more than 2%, and you get the risk premium. You ask for it as well, but that's essentially what you do. Okay, so if the idiosyncratic risk then becomes sufficiently high, then your own shop becomes more and more risky. Then you say, oh, I don't want to borrow in dollars and invest in my risky shop. I'd rather hold only part of my wealth in my risky shop and part I hold into dollars. Okay. Now the question now is, if I live in a world there's only the dollar and the physical capital, when is it the case that the peso can survive on next to the dollar? Okay, so that's what I'm doing here. So here's again the amount of idiosyncratic risk, and then I plot the growth rate of the economy. That's the growth rate of the economy. Okay, and let's consider the case where the Chilean government is not printing peso bonds all the time. It's just they just stick to it. So then the real return on the peso will be equal to the growth rate of the economy. If they're printed at a faster rate, then I have to shift this blue line parallel down. Okay. And other things will of course change too in equilibrium, but let's just keep it this way. And then there's another horizontal line. That's not the zero line. This is a dollar interest rate. Okay, that's this horizontal line over here. Oops, over here. Okay. Always have to balance like a weatherman. And then there's another thing is the required return you want on your capital. Or how much do you require? That's this black line here. Okay, so that's this one. So what is this black line saying? If the idiosyncratic risk is going up, so that's the portfolio, the required risk-free rate. Sorry, the required risk-free rate, the portfolio return, what you get on your on your portfolio minus the risk premium. And if you have more idiosyncratic risk, then actually you want essentially more risk premium. If there's more idiosyncratic risk, you want more risk premium, and that's what's reflecting here. So that's as the idiosyncratic risk goes up, the risk premium is going up. Hence the risk-free rate, the required risk-free rate is going down because you get the portfolio return on the whole portfolio minus the risk premium. So if the idiosyncratic risk goes up, the risk premium goes up. So you must subtract more from the portfolio return. And what you can see here is that the peso is only viable if the return of the peso exceeds the required risk-free return. Okay, so that's essentially what's going on here. So you have the required risk-free return is exceeding, and that's when the peso is viable. So what's going on? So if the idiosyncratic risk is very, very low, then it's a case that your individual capital investments are so profitable that you don't want to hold any pesos. Okay, so you invest everything into your mom and pop shop, and you know, it's a high return, you have a very high growth rate, everything is fine. So the pesos, which just give you the average growth rate of the economy, it doesn't give you any dividend payment. Remember, when you invest in your own mom and pop shop, you get the growth rate of the economy, because your shop grows on average with the growth rate of the economy, plus you get a dividend yield. Okay, on the peso, you don't, on money, you don't get this dividend yield the same way. So that's why if the idiosyncratic risk is fairly low, you invest primarily in your own mom and pop shops and don't invest in the peso. Now, what happens if the idiosyncratic risk is very high, but then actually your required risk-free return is actually lower what you get in a dollar. So you rather than holding any risk-free rate, which gives you what you require, but you get even a better deal by going into the dollar, you get the 2%. You don't want to hold any peso debt either. So you go into the dollar. Okay, so it's only in the interim range of sigma tildes when there's actually the peso is viable, because you get the higher return what you require. Okay, or at least return what you require compared to what your alternative is to invest in your risky capital, or your other alternative is to invest into the dollar investment. Okay, so I should say there's no aggregate risk in this setting. So the peso and the dollar are equally risky. Okay, they are both risk-free. There's no risk at all. All the risk is idiosyncratic, and it also affects only your capital investment, but the dollar and the peso are both risk-free. Okay, so that's essentially what I wanted to say here. So if your idiosyncratic risk is very low, you borrow in dollar, you invest very highly in, so that's what you see here, and also here, then you borrow in dollar, and you invest in this high idiosyncratic risk, but the idiosyncratic risk is not so high, and you own private capital stock. Now, what would happen, so here I made a nice picture, I don't know whether you see it, you get sandwiched. Do you see this sandwich picture? When the US is hiking the interest rate, so if the US dollar were to pay more, okay, but then actually the viable region for the peso is actually shrinking, okay? This is only a partial equilibrium perspective because I just lifted this horizontal 2% interest rate you get on the dollar, I lifted it up to 3%, let's say. But you see already the range over which, how should I say, I have to go here, the range over which the peso will survive is actually shrinking, okay? So that's what's going on here. So that's what you mean, you know, that if the US monetary policy is moving its interest rate up, then it will be the case, it will be harder for the peso to survive because it will be another competition for a safe asset, and rather citizens park their money with the safe peso to insure against idiosyncratic risk. They say, oh, let me insure it with the dollar. Of course, many other things, the partial equilibrium perspective, I show you here, the shrinking. Of course, over there, everything will change too, whether borrow or not, the whole equilibrium, all the curves will move around, the growth rate of the economy moves around. I haven't depicted that in the picture yet, okay? So once we have the peso and the dollar, things smooth out a little bit. So it is the case that you can actually still borrow at the lower rate, at the dollar rate, and invest then much more into the peso. So things what we have before, you remember this was this black curve going down, and then we have the other one, so it smoothes out to this particular curve, okay? But I think the important thing I would like to emphasize, if your idiosyncratic risk were to go up, you know, here you will have a start and stop. So let me just highlight this again. So if I go back to this viability, if idiosyncratic risk, if you live around here and this idiosyncratic risk because of financial crisis going up, suddenly the peso disappears, okay? And you can also see it here, you will see the peso will be disappearing. So the peso is a bubble, and that's what the special thing is about this form of money, and the bubble can disappear like this and has some huge amplification effects, and that's where the sudden stop comes from. Okay, so then there's the question, what's about the policy space? You can of course impose capital controls. You can say we cannot initially borrow in dollars, and we can also then later not really, you know, allow the citizens to invest in dollars, okay? Or go out in dollars. You can also say the pesos, I can back my peso with taxes. So I can say I levy taxes on my citizens in order to not have a bubbly currency or some Ponzi scheme of government debt, which this essentially is. But I have some taxes backing on it, and suddenly before the crisis, before this sigma tilde moves up, you know, the value of the currency and the value of the government bond is to a large extent has a bubble component. It has a backing component, and it might have a bubble component on top of it, and this bubble component goes away. And I can also, as a government, I can hold reserves, dollar reserves, okay? So, but the two trade-offs are, you know, how much should I have essentially the backing, and how much should I have the local currency versus the global currency? Before I go into this, I would like to go a little bit back to a setting where there are only pesos, okay? There's no dollars. And that goes to doing some welfare analysis, contrasting the equilibrium outcome with the optimal policy outcome. That will be important to understand what's going on. And I just give you the intuition because time is limited. So the intuition is that if idiosyncratic risk is very high, it is the case that the optimal policy would put less holding on money and less or more holding on physical capital. Okay, so what do I mean by that? If idiosyncratic risk is sufficiently high, it is the case that money is good. It allows idiosyncratic risk sharing. So because we have incubate markets, we cannot risk share otherwise. But it actually is almost too attractive, okay? Or it is too attractive, and it crowds out physical investment. And why could this be? And it could be because when we were to invest more in physical capital, what happens if we all invest more in physical capital? Then the price of capital moves up. And if the price of Q goes up, the price of capital goes up, or for machine goes up, we will invest more. The iota will go up. The investment rate will go up. And if the investment rate goes up, the whole growth rate of the capital stock and the growth rate of the whole economy goes up. And that also means the risk-free rate is going up as well. And we as individual citizens, we are price takers. We don't internalize this, if we're not pecuniary externality. Okay, so let me say this again. So let's suppose we have the case that I have a portfolio share, 60% I put into my capital stock and 40% I put into my pesos. Okay. Now somehow I force you, instead of 60-40, you make 70-30. What happens is that the capital, now you're forced to hold more physical capital. That means the price of capital QK is going up. Okay, so if QK is going up, then it will be the case that it's more attractive to convert consumption unit into physical capital units. So this iota is going up, the investment rate is going up. But if the investment rate is going up, it also means the capital stock is growing faster. And because it's an AK economy, if the capital stock is growing faster, the whole economy is growing faster. That's a steady state comparison here. So what happens is that the economy grows faster. If the economy grows faster, the risk-free rate will be higher too. The return on capital will be higher, the risk-free rate will be higher. And the planner optimizing that takes all of this channel I just outlined to you, takes this into account. While an individual citizen takes the risk-free rate as given. Okay. And that's a pecuniary externality the planner internalizes, but the competitive market does not. Okay, and that's, for example, what can the planner do? It can say, oh, everybody's actually investing too much into the safe asset, the peso bonds. What I do is I inflate the returns on the peso bonds away, okay, to some extent, to make the peso bonds less attractive. And if that's the case, then you tilt to a 70-30 portfolio arrangement rather than a 60-40. Okay, and then this way, through monetary policy, you can internalize these. These are permanent. There's an optimal inflation rate, in a sense, in order to get the optimal portfolio arrangement which you would like to achieve. Okay, that's this in range. There's also another range when sigma tilde is low. But in particular, if sigma tilde is too low, like let's say it's 0.1, then the money equilibrium is not getting off the ground at all. And in that case, you would actually like to subsidize money. So what you do then, you actually have a money supply growth which subsidizes the money holding. So it's a money supply growth which is lower than the growth rate of the economy. Okay, so that's an empirical question, which side you're on, and that's what's going on. That's what you'd like to internalize here. Okay, now once you take this into account, what's interesting in this world, once you put the dollar into the picture as well, is, you know, what's really the important thing to understand is here that the equilibrium dollar holding is given by this blue line here. So if the idiosyncratic risk is sufficiently low, like in this whole range here, in this whole range, if it's sufficiently low here, then it will be the case that the citizens just borrow in dollar like hell. Okay, and then when the sigma tilde will accidentally jump over this, then they suddenly want to hold the dollar as a safe asset. Okay, so first I borrow, so here's the zero, no? The first I go negative, the dollar holdings are negative, and then suddenly when the sigma tilde goes over there, poof, they say, okay, now I want the dollar, have the dollar as a safe asset. So the equilibrium outcome is very erratic in a sense if there's some movement in the sigma tilde. While the planner's thing is this red one, so the optimal policy is much smoother. So in general, the planner wants to borrow less in dollars, but then also doesn't want to invest so much in dollar as a safe asset. Okay, and that's quite a striking feature of this outcome. Okay, so that's what you see in this world. And the intuition behind it is that for idiosyncratic risk, it's actually good to have the local currency because you leave the resources in your country. Okay, you just create this bubble, and the bubble, is the seigniorage from the bubble, and everything stays in the country. You don't pass it on to the US in particular if it's the global currency is US dollar. Okay, but the individual citizens don't internalize that. So they'll say, okay, if the idiosyncratic risk is sufficiently high, they'll go actually then go to the dollar. Why is this jump occurring here? That's because if idiosyncratic risk becomes sufficiently high, people don't hold the idiosyncratic capital stock anymore. So people invest less. So QK is going down. The price of machines is going down. That means the IOTA is going down. The growth rate is going down. Hence, the risk-free rate from domestic peso holdings is below the dollar holdings, and suddenly everything shifts over to the other country, shifts over to dollar holdings. Okay. Okay. So idiosyncratic risk creates demand for money. That's store value. In equilibrium, we have some dollar holdings and peso holdings. The return on the dollar is fixed, 2% or whatever you want to put the numbers there. You can pick 0% as it's more realistic these days. And you can have the peso holdings as well. And there's the local currency is a bubble, and there's only a value within a certain range of idiosyncratic risk. So if you have a model where the idiosyncratic risk is itself a stochastic process, you can see that things are playing around this way. And then there might be a sudden stop when the sigma tilde were rising beyond a certain limit. Then there's suddenly people switch from dollar borrowing in dollars. Suddenly they want to hold dollars as a safe asset. First they say, oh, it's a cheap funding opportunity to fund my own shops and my own firms. And suddenly said, oops, the idiosyncratic risk is so high, you switch into dollar as a dollar hoarding, and you don't want to hold essentially the pesos anymore, because the return on the pesos depends on the growth rate of the economy, which in turn depends on the growth rate of the investment rate of the citizens in the economy. If the idiosyncratic risk goes up, they cut it back, and they also then cut back on their whole domestic investments. And this erratic shift and this differs significantly in the optimal setting. The individuals hold more dollars than socio-optimal and if once you make this shift. Okay, that's much more smooth, as I've shown for the optimal planner solution. And all these are market failures due to incubate markets, and these are market failures because the planner internalizes pecuniary externalities while individual citizens don't. So that's a lesson from idiosyncratic risk. The main lessons you take out from this. Now, what I want to do is I want to go to the other extreme. I have no idiosyncratic risk, and I have only countrywide shocks. Okay. Now, and the lesson from that will be the equilibrium outcome will be the optimal outcome if they're only countrywide shocks. And then we put everything together with country and idiosyncratic risk. Okay. So now we have no idiosyncratic risk, and essentially the country, all the citizens are the same. No, there's no difference. The citizens were different because they had different idiosyncratic risk, and they try to self-insure themselves holding this local currency or the dollar to self-insure themselves against this idiosyncratic risk. Now, each citizen is essentially the same, so just choosing the citizen's optimal problem is the same as the country's optimal problem. So Chile's, for example, an optimal problem. So you choose essentially investment rate, the consumption, how many capitals you purchase and sell to maximize the utility. And it's also very similar to a paper Patrick Bolton, Ning Zhang, and Wang have written in 2013, where essentially it is about a company saying, oh, I choose my optimal investment strategy and my cash holdings. Here are the dollar holdings on this. So there's no idiosyncratic risk. So there's no this bubble, this piece of bubble doesn't occur. It's only how many dollars do you want to hold in terms of cash. Okay. So you have the evolution of the capital stock, and you have this, you're purchasing and selling the capital stock from abroad now, and you have the evolution of the dollar holdings here. And again, when you sell some assets, you get Q lower bar. If you buy assets, you get you have to pay Q upper bar. Again, we do it not in K in dollars, but our state variable is this ratio of the two. So that's this dollar holding per capital unit. So we apply Ito's ratio rule. And then we get the evolution of this nu. Okay, that's just pure math. And then we get the value function. So I'm running a little bit out of time. And we have, so if you go away from a log utility, now it's more general, in the paper it's more general. And so gamma is equals to 1 in terms of log utility, but here we have it more general. It is useful to write the value function in a component, in two components, one where you bring out the k to the power 1 minus gamma over 1 minus gamma, and then a remaining part of the value function, which then is only a dependent variable of nu. Okay, so the value function is a function of nu and k, but we can separate the two components. One is only k and to the power 1 minus gamma or 1 minus gamma, and another component which is a function only of nu. Okay, and we saw already this k is evolving fairly on its own. So of course it depends on the iota, and it depends on the purchasing decisions and selling decisions. But once I have that, I know how the k is evolving. But the nu, I want to solve that. Okay, so the value function component as a function of nu, that's what I zoom in. And I make everything scale invariant with respect to k, so I can solve a one-dimensional animal. Okay, so otherwise I have a PDE to solve. By separating them, I can solve an ODE. Okay.
Marcus, quick question.
Yes.
So nu was, I think it was dollar by capital, right? So
that's a dollar per capital. Yes.
Right. So can we separate the value function between dollar and capital? No, right? Like just because f is not separable. Is that right?
No, so the value function, the way you could write is the capital V as a value function would be a function of the two-state variable, which is nu, and the capital stock, the aggregate capital stock in the country. So it's a function of two variables. And then I separated, one is the f of nu and k, which takes, you can say g of k, where g takes on this CARA, this constant relative risk aversion form.
Right. My question is, can we separate it between dollar and k by substituting?
No, we cannot separate between dollar and k. We can only separate between k and nu, because if you go to dollars, then there would be implicitly the k inside again. So for example, what the beauty of this nu is, going back what we said yesterday, if I look at, Chile and Argentina, or I don't know, some other country, Peru, and let's suppose, so I don't know which, Chile is twice as large as Peru, I don't know, I might be wrong on that. Then these two countries would have, Chile would have twice as many dollars as Peru has, and I want to treat these two countries the same if they have the same sequence of shocks. Okay? They're identical countries except in the size, and this way I have to look at this nu rather than in the dollars, because otherwise, if this function is not linear, if I were to make it in dollars, I cannot, scale it the right way.
Makes sense. Thank you.
Okay, so that's the HJB equation. Essentially, is if this is my value function, rho times the value function dt, so that's the change is maximizing the flow utility plus the expected change in the value function. And here we again use this Ito's lemma, because we get, the first derivative times plus half second derivative, as we did already in the previous, in Thursday's lecture. Okay. And we have this iota is driven by the Q price. So I just set up the problem this way. We will solve it more generally. You cannot solve it so analytically as we did in the pure idiosyncratic case anymore. So you have to go more numerical on that. But the important lesson essentially is that, and it's obvious that without idiosyncratic risk, the equilibrium outcome is optimal, because equilibrium just means they're all the same, they're all scaled versions of each other. And the equilibrium outcome is then the planner's outcome, and hence the conclusion from that is that any difference between equilibrium and optimal outcome has to be due to idiosyncratic risk frictions. Okay? The idiosyncratic risk drive this difference. All the results are driven by the idiosyncratic risk. And that's why the insights we got from the idiosyncratic risk are still, you know, the main insights. Of course, once you get the aggregate risk on top of it, you get a better model to be calibrated and bring to the data, because of course there's a lot of aggregate risk in the economy. Now, just to show you here some settings where I change the amount of aggregate risk. Okay, so these are two economies, these are two steady states, two economies where the aggregate risk is higher. And the first picture to look at, so the state variable is always this nu. So that's on the x-axis on all of these pictures. That's a stationary distribution. Let's start with a stationary distribution. That's, as we talked yesterday, if you let the system run for millions of years, how much time will it spend on average? How many dollar holdings per K will it be holding? Okay. And what I contrasted with is a sigma of 10% with a sigma of 15%. That's the aggregate volatility. Okay, the countrywide shocks. You can see if the country has larger aggregate countrywide shocks, the dollar holdings are typically higher. Okay, the country holds more dollars. If the sigma is only 10%, the country is mostly borrowing in dollars. So this is a zero. It's, you know, most of the time it borrows in dollars. Okay, why? You know, given the parameters, it borrows in dollars, and then it invests in this in its own private with idiosyncratic risk load and investment opportunities. But it's, you know, it's a good investment opportunity. Now, so that's where the system lives. The state variable lives here. So most of the time you spend here if you set 15% aggregate shocks, and otherwise it lives in this system. So you can see, and the drift is the same thing here. This is stochastic steady state. So the drift is positive. So if you're over here, you drift back. So of course it is stochastic. It drifts back to the stochastic steady state. If you're over here, it drifts back to the stochastic steady state. Of course, it's constantly shocked. It always lives around here, and the stationary distribution is given that. If you have 15% volatility, you have more volatility, but the stochastic steady state is mostly have positive dollar holdings on average. And of course, sometimes you have too much dollar holdings, and then you decumulate them again. Now, you can also contrast the Q, so that's the price of this capital stock. Of course, you have to be careful how to compare the blue and the red curve here. Of course, the blue curve, the system lives mostly here. So the relevant part is this part. And the red one lives mostly here. So they're not so far apart. But you know, the growth rate is of course higher if there's less idiosyncratic risk. So that's what shows here. So if you have the same amount of dollar holdings per unit of capital, the growth rate will be significantly higher, or the price of capital will be significantly higher. And that means also the growth rate will be higher, because iota is just a direct function of Q because of Tobin's Q. Okay. Now, we can also understand the squeezing, the sandwiching without aggregate. So what happens if the risk-free rate goes up? It's going up. Or let's get the risk-free rate is by risk-free rate I mean the dollar interest rate is 0, and it suddenly moves to 5%. So you can see that the stationary distribution, if the dollar interest rate is 0, we mostly borrow, or you borrow and you hold safe assets, positive dollar positions, given these parameters over there. But if the interest rate is higher, then you hold much more than you borrow. Okay, and again, that's the drift. You see sometimes if you borrow a lot, so you have a very low dollar position, so far below zero, you accumulate dollars. If you have a high, you decumulate, same as before. But the stochastic steady state depends, of course, how much the interest rate is. If the interest rate is higher, you borrow less. And it translates immediately in the Q, which again translates into the growth rate as well. Now, then what you can do is that, okay, what we're really interested in, this was only, as if there are only countrywide shocks, there's no role for a peso in the first place. No, there was only the dollar in order to insure yourself against the countrywide shock. Within the citizens, they cannot do anything because they all face the same shock. And with idiosyncratic risk, you can have the peso to do the idiosyncratic risk insurance, and you have the dollar to do the countrywide risk insurance. So now we have both components. But is it done the right way if you let the market do its own way without government intervention? Okay? And that's what we indicated already. The dollar becomes too attractive as a safe asset, and they should actually use the peso, but the market is not internalizing many effects. And that will show up in the general solution. Now in the general solution, then now it gets full force of what we have learned so far. We have these three portfolio shares, we have the consumption share rate and so forth. So we have to deal with all of these things simultaneously. So I have essentially only a minute left or so to go over that. But again, we do this value function as we did in the other case. So we decompose the value function in two components, one which is a function of nu, and the other component which is a function of k. And we separate the two, and then we solve for the v of nu, or f of nu, what we called it earlier. And that's essentially what we do. So you have the optimal solution, you type it in, and you have the stochastic discount factor and all of these things. You solve for portfolios, the total portfolio, you solve for the peso component, you solve for the dollar component, and you have the optimal investment rate. And I don't have the time really to walk you through that. But what you do at the end, you end up with a system of such equations. You do the value function iteration, what Yuli mentioned last time, saying you start in a billion of years from now and say, okay, there's a regime change at cap t billions of years from now, whatever the regime change is, everybody gets a fixed value of utility at that time. And we start with this random value function in 1 billion years, and then we iterate backwards. And if billions from years, it doesn't really matter, it's too far in the future, you converge as you go backwards to a value function, which is then converging to the one we want to analyze. And you do this for the market solution. The market solution, you have certain conditions you have to satisfy. These are the 4 conditions. For the planner solutions, 2 conditions don't have to satisfy it, because the planner can choose the asset price rather than take the asset price as given. And let me just show you some results. And that's, I think, the most insightful or main result, essentially. Again, we have the dollar holding per unit of capital here. And we have this for different levels of idiosyncratic risk. Okay, and here we also have that, and this is the portfolio share, portfolio weight on the local currency in pesos. Okay, this is a drift, and just to see where the system lies most of the time. So if the idiosyncratic risk is very low, the system is lying here. The idiosyncratic risk is very high. The system is lying here and drifts back. The steady state is stochastic steady state where it crosses the zero line. But what happens is that the portfolio weight, if the dollar holding as a function, so if a very idiosyncratic risk, what you can see, the portfolio weight on the local currency is given by this function. So what I do is for different dollars, so the system lives for low idiosyncratic risk, so I don't know how to, let me see. The system lives here, and then if the idiosyncratic risk goes up, the system lives in a bigger range here. Okay, the lower range goes away and then it becomes a bigger range. But portfolio in the local currency goes up and then it comes back down. Okay, I wished I could draw on it, but I can't in this setting. So it goes up and then it comes back down. Okay, that's this inverted U shape. Of course, the whole region shifts, the state space shift, the relevant new space is shifting this way rather. So this way it shifts, but it shifts this way, it goes up and then it comes back down. Okay, that's the inverted U shape. So what does it mean? It's the same what we had before. If the idiosyncratic risk is very low, it's like with only idiosyncratic risk. If it's very low, the own investment in your own physical capital is so attractive. It's very low idiosyncratic risk. You borrow in dollars, you like to borrow in dollars, so mostly you live in this region, okay, whereas below zero, you borrow in dollars, invest in physical capital at home with low idiosyncratic risk, you invest a lot, the QK is very high, the investment rate is very high, the growth rate is very high, and everything is good. So why should you hold a lot of dollar? You borrow cheaply in dollars, okay? Now there's an intermediate range. In the intermediate range, the dollar and the peso can coexist, okay? Because there's some idiosyncratic risk, and you want to self-insure against this idiosyncratic risk by using the peso ideally, okay? So that's what intermediate range is going on. So that's, and of course, the growth rate in the economy will be lower because you park some of your money in some bubble rather than in physical capital, but it's high enough that the peso can survive next to the dollar. Now, if the idiosyncratic risk gets even higher, then it is the case you can't park it anymore. Then you don't want to really invest in your physical capital. It's so much idiosyncratic risk. You would like to have a large chunk of your portfolio in some safe asset. Of course, the dollar and the peso are not perfect substitutes, but they both are safe assets in theory. But the growth rate is then, you don't invest so much, IOTA is low, so that you don't invest, the investment rate is so low, so that's why the growth rate of the economy is so low, and that's why the return on the peso is very low too, okay? And that's why if the interest rate in the dollar is high enough, the peso collapses, okay? And that's why you see this inverted U shape. So the peso can only survive in the interim range, and that also means you have a huge amount of dollar holdings if there's a lot of amount of idiosyncratic risk. And that's what you see. These are the numbers. The amount of idiosyncratic risk are the numbers written on this, and that's a portfolio share, how it looks like. And it's essentially if the idiosyncratic risk is sufficiently high, so like in this case 0.31, you hold 0 pesos, okay? If it's 0.1, you hold 0 pesos. If it's 0.15, you hold some pesos. If 0.175, you hold more pesos, and so forth. Okay, I'm running over time. I know I eat into your lunch break. And then you can, of course, also show the sandwiching more generally in this setting too. What happens if the US Fed hikes interest rate? You squeeze essentially the peso and make the range where the peso can survive smaller and smaller. And you can see it if the interest rate is going up. Of course, you borrow less, and the dollar, the peso holding is going down. So that's what this figure shows here as well. Let me just say, conclude, the optimal holdings are very different from the equilibrium holdings, and that's what this figure shows. And let me just state it at the end. The optimal holdings are not very sensitive to the sigma delta. Okay, so the optimal dollar holdings are not very sensitive to the sigma delta, sigma tilde, while the equilibrium holdings matter a lot. So you would like, as a planner, keep the resources in the country, invest in your local peso bubble, and do the insurance in the local peso bubble. But as soon as the growth rate shrinks in your country because people don't invest don't keep the money in the country, then everything shifts over to the US, and that hurts the whole economy. And it's the same intuition as I did in the bigger sense. So let me summarize what we try to accomplish here. So I went a little bit fast. We tried to accomplish that. Hey, when can two currencies survive in equilibrium? And there are many papers out there saying, okay, there's blue and red currency. They're always perfect substitutes. Okay. In our setting, they're not perfect substitutes as a store of value because they have this aggregate countrywide shocks. So they have different risk profiles. If you want to have a model with different risk profiles, it's much too difficult to deal with a discrete time. It's way more elegant to deal with a continuous time framework. And that's what we done. So when can two currencies survive? So that's the first question. And when will the local currency driven out by dollarization, or the US Treasury will be the safe asset and the local bond is not the safe asset anymore? And these are the questions we try to answer here. And you get an insight, and it's surprising that if the idiosyncratic risk is very low, then the local currency cannot survive. And if the idiosyncratic risk is too high, it cannot survive. And if there's essentially the U shape here, there's a sweet spot in between where the local currency can survive on top of the dollar. And the planner likes the sweet spot in between, would like to expand the sweet spot, would like to invest less in dollars because they said, okay, let's keep the resources in the country, invest in our own bubble rather than park it somewhere else where it might be not productive for the country and not driving up the growth in this particular country. So with this, let me stop here. Are there any more questions?